Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. All right, Zane, welcome back to the Energy Desk, sitting here on November 22nd, earlier in the morning, 9:15 a.m. Central. How's it going?
Great. Good to be with you, as always. Got some new topics this week that we really haven't covered or haven't had the opportunity to cover because they haven't been topics. So let's kick it off. I would like to hear from you on some of the macroeconomic headlines. Maybe let's start with consumer and household loan defaults. I know you got some thoughts there.
Yeah, so this was kind of related to some of the pieces that we put out on the research archive this week, but looking at the Q3 data for the Federal Reserve Bank of New York's, they have, I guess, a couple different quarterly reports, but kind of concentrating on the takeaways for household debt quality, we got to see, I guess, kind of a continuation of a trend that's been going on for the last couple quarters where, well, one, I guess you have total household and consumer debt just reaching new records each quarter measured, but also the flows into serious delinquency for various household loan types have reached levels that we haven't seen since kind of the tail end of the 2008 to kind of 2012 financial washout from, I guess, both credit cards, household mortgages, and a few other things. So I guess kind of in that theme, takeaway, big one is that there's kind of underlying weakness in the consumer side of the U.S. economy. I think that that's going to translate into some revisions to jobs reports that we've seen in the past. And I can, continue into that theme because I have another point on that. But I guess first, your takeaways on some of the credit conditions and how this maybe fits into the demand landscape for the U.S.
Well, I mean, my first thought is like, what good American citizens doing as its government does, rack up more debt. I guess that's what we do now. The housing market is an interesting one to me. I read something this week about the mortgage, not necessarily defaults, but the delinquencies in mortgages. And the interesting fact was it wasn't just from, call it the lower end of the spectrum. Some of the, subprime, it's maybe not really even a news story, but even some of the jumbos were seeing a significant increase in delinquencies. So, what does that mean for energy markets? I don't know. In some ways, like it's maybe the tip of the spear in that there's some headwinds, like you said, from, jobs data. I mean, at the end of the day, we have to ensure that we don't freeze in the winter. We're going to drive from A to B. So is it a material demand impact? I think that's a tough read through. However, just the, I guess, fear pandemic that seems to be growing by the minute for crude oil, there could be some headwinds there. And that obviously we won't cover it this week, but is the mounting evidence on the things don't look so great stacks up against a spec community that's still kind of on the sidelines. So we can't be surprised if we find ourselves in the mid to upper 70s sooner rather than later.
I guess, on the employment side, interesting report from this week for the Bureau of Labor Statistics, BLS, was their quarterly employment and compensation report on, I guess, Q2. So released in November, but looking at data through June. And when we look at the U.S. employment change, annualized change in U.S. employment, that actually fell to 0.8% in June. And it fell from 1.3 in May. So 1.3% in May. And when we kind of look at the historical trends in that kind of, I guess, cautionary signal that I would encourage listeners to maybe check out is how that compares to the rates from the 2006 to 2008 window and kind of these early indicators of maybe something more substantial happening in labor markets where, as I said, down to 0.8% annualized change in U.S. employment for June 24 over June 23. Looking at 2008. In December 2007, fell also to 0.8% annualized change, and January down to 0.7. And then, as listeners are obviously aware, after that is pretty considerable fall down to over minus 5%. So just one to watch. I think that the revisions that we've seen to what were originally kind of rosy or dovish jobs reports, kind of cut those down to something that was negligible. I think that's probably a likely trend to continue, and just something that's maybe, as I said, kind of cautionary tale.
So we're late paying. Jobs data doesn't look so good. The Fed says inflation is fading and recently cut rates again. And I would just ask anybody when they go to the grocery store to stand there at the counter and say, do things feel like they're getting cheaper? I imagine the answer.
Yeah, and that's kind of the common thing, I guess, with these headlines is the inflation numbers are falling down to a certain Fed target, but it is disinflation, not deflation. And so I think, that's a good opportunity in the inflation side to dig into what's going on with the dollar this week. And maybe I'll just let you kind of take that one.
I'll just start with the headlines. This is stating the obvious. In, I think it was late September, early October, the US dollar index bottomed at just over 100, and we're up about 7%, trading this morning at 107.5. So quite the rally for the US dollar. For listeners, that is a 1-year high. And when you look back over many years outside of 2022, when I say many years, let's just say over the last 5 to 7, very strong levels for the US dollar. So what does that mean for energy markets? Let's say the, I guess longstanding historical context would say when the dollar is strong, it should be a headwind for U.S. crude exports, meaning the buyer of U.S. crude doesn't have as much buying power. And conversely, the U.S. crude importer would have more buying power, which, we'll see what happens. And maybe we'll get to this a little bit later with the new energy secretary coming in. We've often discussed the relevance of the SPR again. It's been kind of quietly sitting in the background, acting as like a little mini OPEC, helping to support the market by taking barrels from commercial stocks. And where this becomes interesting is if the dollar's strong and it does incentivize strong crude imports, like this week's DOE data showed, where's that crude going? While there's plenty of space, crude inventory levels are low, kind of across the board. Let's say 6.5 to 7.5 million barrels a day of crude imports all of a sudden creates an interesting challenge for the U.S. producer that's saying, no, I want to fill that space. So I think, yet to be determined, the idea that the crude and the dollar are inversely correlated, you can find just as many instances where they're positively correlated at near a 1 as you can instances where they're negatively correlated. So I'm going to crumple that one up and throw it in the trash and say it doesn't really work. It's just a fun little thing for a Reuters writer to, they don't have anything to say today. So let's talk about the dollar and crude moving together or opposite one.
Yeah, it seems definitely like very contingent upon the kind of driver. So the supply side or demand side, what's kind of the primary focus. But, as you mentioned, as kind of the July to September 2023, dollar and crude were moving in lockstep. So definitely not inverse all the time as we kind of.
All right. So what's happening in the rest of the world? What does the rest of the world think about a strong US dollar?
So it's kind of a particularly interesting time because you have strong dollar, which is a reflection of kind of this elevated risk premium. So on one front, you have the geopolitical conflict. You have Russia, Ukraine kind of stepping up and escalating for a few reasons that we'll get into. But on the second front, you have new, President-elect Trump coming in. Tariff threat is a real one for foreign exporters who have expanded their trade surplus against the U.S. to all-time records for the last several quarters. And then you kind of have this final piece that is kind of recession fears in areas like Europe. You have issues kind of in the China landscape, Japan, and this kind of relative performance for the US versus non-US economy and what that means for yield spread. So the yield spread, US Federal Reserve maybe not expected to cut rates as quickly. Other central banks are cutting rates, so that yield differential is pressuring foreign currencies, causing capital outflows to the US, chasing the dollar. But I think really the point that loops that together is that when exporters have a massive surplus against the US and they are making efforts to reduce that surplus to kind of, reduce the target surface area for tariffs, that also adds a lot of tailwinds for the dollar. And when the dollar is strong, it indicates kind of a shortage of dollars. So how are foreign central banks or reserve managers going to get those? And then I think really the risk that's worth pointing out is that these are the same folks who own most of the U.S. treasuries. So kind of as we've seen this week, Japan and China had, Japan's case, record treasury sales in the third quarter to get some dollars to recoup those that they spent intervening in currency markets. China had the second largest treasury sales on record. So combined, those two were about 110, 115 billion in treasury sales. And, I don't want to continue on and rattle, but I think the final takeaway is that there are some underlying risks in where speculators / hedge funds are positioned related to treasuries and some of the trades that are out there that could unravel. And that would kind of have a cascading effect that would drive up short-term borrowing costs is the primary risk, and definitely a volatility risk that people should be, taking note of. Yeah. All
right. So you mentioned some of the headwinds in Europe. Maybe let's stay on Europe and kind of finish up the dollar versus some other place in the world discussion. I know you had some thoughts on Germany, UK. What are you seeing in the PMI data there? And then how does that compare to what we're seeing in the US?
So that came out today, actually, for the flash S&P Global and related PMI estimate. So Purchasing Manager Index, kind of just the measure of business activity. And so in the EU, Germany, UK, they're all seeing their composite. So the combined of services and manufacturing, those are contracting. Manufacturing is contracting. And for most of these cases, they're contracting faster. So really in Europe and in the UK, the big concern is recession. And they're in a tough position because their central banks have to kind of navigate around the Federal Reserve and what their moves are going to be, because as I mentioned, widening that yield differential is going to put pressure on currencies and therefore put pressure on a lot of their businesses that might be exporting or importing. And so, that's on the European front. On the US front, the composite PMI went up to 55.3 from last month's 54.1. Services were kind of the main driver of that. So services were up to 57 from 55, whereas manufacturing was nominally up at 48.8. So still in contraction territory. And that's the fifth straight month for manufacturing for the US in sub 50 readings. So, I think really that composite indicator for relative strength is kind of the first takeaway, is that US is still kind of pushing on. I think there's a lot of signals that people should be paying attention to where it's maybe not as robust economic activity is not as robust as maybe some of the Fed's indicators are showing currently. But relative to the EU and UK, we're in pretty good shape. So I think that's really kind of the risk that we highlighted before with the dollar, kind of the relationship.
I really appreciate you being able to break all of these different indices down. Listeners, please go back and find the show notes. I know he's got a lot of great data for you to reference while maybe even going back and listening. And I just can't help but make a blanket statement. The number of indices themselves make your head spin. So, I think you're most or best suited just to kind of stand back from 30,000 feet and say, hey, what does this feel like, instead of getting tethered to this index is, the signal for what's about to, almost mass confusion. The one, I guess, final comment I'll make that seems kind of interesting with the U.S. numbers, services up, manufacturing down. Doesn't that sound like the story from China in the past year and a half, which is, an interesting topic when you've got a make America great again president ready to take office for the second time, with their, consistently on the campaign trail and even in his prior term, the idea was bring manufacturing jobs back to the U.S. So in some ways, of all the data that you shared, I think that will be the one, say, over the next year that ends up getting a lot of attention. Certainly because before that, the expectation is that there will be tariffs. So the tariffs are in some ways meant to incentivize more U.S. manufacturing.
And it does seem like that is having an effect on commentary, at least. We'll see if that comes to fruition. A lot of South Korean manufacturers, Japanese manufacturers, kind of steel makers are all indicating a willingness to move operations to the U.S. So it'll be interesting to see if that comes to fruition. But I guess, transitioning to one of the topics that has taken another turn this week on the geopolitical front, Russia and Ukraine. I think you have some interesting thoughts that you shared on DMU's daily market updates this week.
Yeah, I'm, I guess certainly apt to be a bit tongue-in-cheek, and if I offend someone, I apologize. But this literally feels like two 7-year-olds in the sandbox fighting over the one toy. And the kid that's got the toy that's told he has to leave the sandbox, President Joe Biden, is trying to break the thing before he leaves. All right, so there's my color. I mean, pretty fascinating, as, you kind of get this seesaw of information all the time. Ukraine is beating back Russia. Oh no, Russia is making advances. Good luck making heads or tails of that. It's kind of like the 400 economic indices out there. But this week, so here we are, final innings of the Biden administration, and we are sending long-range missiles. Well, they arguably were already there. I'm sure they were. Why would we have had them there if they weren't meant to be used? But permission was granted this week. Fire away. I think these things don't exactly just get FedEx overnighted. So in some ways you can say the plan was already in place, but the green light was given. Ukraine has launched, so far what I've read, 1 salvo, 6 missiles, 5 shot down. 1 did a little bit of damage. Russia's response was to move a forward air base back. And then the headlines kept it coming, with the Biden administration also seeking to and strongly indicating they believe that Congress will approve forgiveness of half of the loan debt that Ukraine owes us. Now, mind you, that half of that $4.6 billion is like a pin drop on what has actually been sent. That's just the part that we said, hey, you got to pay us back for. The rest of it's good old U.S. government grant. And, certainly in the most recent election, there's some strong and mixed feelings about what we should or should not do in terms of involvement in Ukraine. And the other kid that's now moving into the sandbox, the other 7-year-old, says, I'm going to end this war swiftly and we're going to come to a conclusion. Well, when you start launching long-range missiles, and then I think it was Wednesday, we also then approved the use of landmines, which is another really fascinating one, in my opinion. It's a kind of an old school tactic. And the story is that Ukraine says we need to beat back these ground forces that are making meaningful progress, incursions into Ukraine territory. And it's not so much the heavy equipment that we're having a problem with. And it's like, well, wait a minute. If you're supposedly, because of all of these billions of dollars of US and UK and French support, you've been winning, air quote, the war against Russia. How exactly is it that just ground troops are making significant incursions? And then this then brings up a whole new human rights storyline, while nowhere near as catastrophic. I don't know because I'm not there. But I would imagine nowhere near as, even on the scale of what we've seen in the Israel Israel-Palestine conflict. But the statement that we're going to use landmines on our soil to prevent the incursion of Russian troops, but they're not going to be where civilians are. Well, how exactly are you guaranteeing that the civilians aren't going out there? I think if you put up a sign that says caution, landmines here, they kind of lose their relevance.
Yeah, it is a little messy.
So it's an interesting, I mean, and so I think conclusion, like why does any of that matter? Outgoing president says game on, full support. Incoming president says we'd like to pull back support. And what it's left Russia with is, well, we don't exactly know what's going to happen. And we've made our case clear and we are not stopping. And with North Korean troops now on the ground, certainly feels like escalation is not going to slow down in the next several weeks, at least. Next few months, a bit of an uncertainty. And I think that goes back to the point about, don't be surprised if there is finally a geopolitical headline that does lead crude back to some higher levels at the front of the curve. We're presently trading at $71 even at the very front of the curve, and that's now the January WTI contract.
Yeah, and it was also interesting, I think, going further into the permission. So Biden administration approves the use of, the U.S. missiles into Russian territory. Then I believe it was the next day, UK did the very same. So it's kind of this cascading effect of now, U.S. approved and everybody else that's been kind of lending support to Ukraine. We want to get some support in there as well. So I think it does have escalation between especially Russia, Europe, and it'll be interesting to see, I guess, what that translates into for crude. Yeah, I guess we can keep on the crude front, or we can take a look at what's going on with natural gas this week, which has been pretty interesting to watch.
Yeah, let's go there. Natural gas has been the stepchild for several weeks, and that it's just been a slow, painful grind down in one of the mildest mid-Octobers to mid-Novembers on record. So some considerable jumps. The front month NYMEX natural gas contract overnight, that's still the December contract, is until next Tuesday, traded up to 356. That contract was down around 270 not that long ago, and that would be early November. And then you've got, on a rolling prompt month basis, we're up over $1. So certainly some moves. Why? One reason only. Well, not one reason only, but the primary driver, weather forecasts from one of the warmest, meaning top 3 warm mid-October, mid-November since 1950. We are now seeing a transition to a much different weather pattern that's got some Arctic air flowing southward from, I'll call it the BC area, into the lower 48. Most of it will be hitting call it to the right of the continental divide or the east of the continental divide, if you were staring at a 2-dimensional map. That cold air mass has the week of December 5th up to 204 population-weighted heating degree days. What does that number mean? Well, that's almost as cold as peak winter temps on a normal winter. So late January is the coldest time of the year nationally, and we're only about 10 degree days behind that. I think the interesting thing, and we've written about it in the daily market update, is vendors have been behind weather models, meaning models have consistently been colder and vendors have been chasing it. This morning, there was a slight warmer revision on some warmer changes overnight. However, when I look at the weather model output, it still looks a bit colder than the vendors. So what does that look like when we come in Monday? This morning, the front month NYMEX natural gas contract is traded down to 312 from the overnight at 356. That's quite the move. So we're getting some volatility back intraday, and there have been some big swings in cash markets as well. So why are we down today? On one hand, you can just say, well, we went a long way in a short period of time. So there's some profit taking from the bulls that had just been waiting patiently for something like this to show up. And then there is also a backpedaling in spot markets for the weekend. However, The weekend is still very mild, particularly along the Gulf Coast, southern tier of the country, but even through the eastern seaboard. And then by Wednesday of next week, before we gorge ourselves on turkey, the cold air mass is supposed to arrive across most of the eastern half of the country and intensify throughout the next week. So how does that cold air mass and the typical holiday effect, meaning demand fades from the industrial sector, the power sector, how do those align? And I think the final comment I'll have on it is, will we see 150 BCF draw or greater for the first week of December? That number is interesting because as of yesterday's 3 BCF withdrawal, that's a very small one, but on a weather adjusted basis, it is still slightly bullish. So if we see another small draw, even a small build, we'll kind of tread water. Same week last year, we did a +5, meaning on this coming Thursday. So where will that leave us? Well, that will leave us going into that December 5th week with 141 BCF surplus. So let's just say we don't know exactly where that number is going to come out. Somewhere between 130 and 100 year over year surplus. Well, 150 BCF withdrawal wipes that out, and then off we go. We don't have more gas than we did last year. And what comes next? So I think the real interesting thing will be if we come in early next week and the end of the forecast is still cold. Sorry, I said last comment. I got one more that I feel it's really important to share. Spot markets. For those poor Permian producers that constantly feel like they're having to deal with almost like a gnat buzzing around their face, meaning natural gas markets in West Texas, New Mexico, most of them will say that the price of gas is insignificant. It's not really something they care to spend much time on until it's trading negative. So there's been a lot more attention on the Waha gas market over the past summer. In just the past days, there has been a material improvement in Waha pricing. This morning, Waha was trading $2. That's a positive $2. Waha at $2 is 40 cents behind the hub. The front month basis or December basis for Waha was as weak as minus $1.72 a little over a week ago. As of last night, it was into minus 75 cents. And with the spot market trading 40 cents back, is there room to go? So why? You had the Matterhorn pipeline come online in early October, but it might as well not have come online because several other new pipes, still odd that new pipes go down for maintenance as frequently as they do. The Matterhorn pipeline came online. These other pipes went down for maintenance. And so it was as if there was no new capacity. And now that everything's back and flowing, two things are important. Waha has massively improved, and there has not been a significant downward effect for Houston Ship Channel. Houston Ship Channel December basis was minus 45 cents a little over a week ago, currently at minus 22 cents. Now today, for the weekend, a very mild weekend in Texas. Houston Ship Channel is trading a little over 50 cents behind the hub, so certainly that's much weaker than December basis. And our expectation would be that as you come in early next week and there is some better temps in the forecast, that you could see some tightening. The chaos that can ensue, though, is you've got an interesting week next week for the physical market. On Tuesday, November 26th, the physical market will try to spit out from its random number guesser how many MMBTUs to buy for the 27th, 28th, 29th, and 30th of November. Every weekend, the market has to trade for a 3-day package. Holidays often fall like this. So the market will have to trade for a 4-day package. But even more importantly, on November 27th, physical markets will have to try to trade for Sunday, December 1st, and Monday, December 2nd. So on a Wednesday, you have to guess how much gas is going to be needed for Sunday and Monday, which are much colder days. So I don't know, interesting times ahead. And certainly we've seen the underlying tightness with just a little bit of weather show up in the forecast meaningfully change the direction.
Yeah, absolutely.
Man.
The short, as we talked about, I think last week, the short side of spec positioning also has an interesting relationship there. So it'll be interesting to see how that comes out in today's CFTC data.
Mother Nature's undefeated heavyweight champ. She'll decide if we get more cold in the forecasts, onward and upward. Any capitulation back to a prevailing warmer than normal pattern, 275 will be the market's friend again.
Awesome. Okay. So let's dig into kind of this final macro topic related to crude markets, and with China's October refinery runs and crude imports. So kind of lay of the land. China's customs data, crude imports fell about 8.7% year over year, and we're down 1.7% month over month. And what does that look like in real numbers? So crude imports dropped to about 10.4 million barrels per day in October. So down roughly 562,000 barrels month over month. And then refinery runs, those similarly fell in October by about 271,000 barrels per day versus September, and we're down about 1 million year over year. And kind of, I guess, two related points in here is that you had some refinery outages that could impact that number, but those refinery runs have contracted on an annualized basis for 11 of the past 12 months. So it's not just the transient refinery outages. Maybe points to something more on the kind of broader concern in crude markets about what is China's demand. So what are some of your thoughts for listeners to maybe consider?
I mean, Matt, I think you nailed it on the headline numbers. Down is down. No good news yet from China. I think I'm going to kind of deviate a little bit because I think you kind of exhausted the topic and really told people all they needed to know and say, one of the add-on effects to the things don't look so great from China is that OPEC's production, if it follows the path that they've projected in their September 5th release, that was the data that OPEC put out. It's on their website still. Go to press releases and you can go grab it yourself, or you can ask Mobius and we're happy to share it with you. That data would show from Q4 24 to Q4 25 an additional 4 million barrels a day of production if you couple it with the projected increases they have for the rest of the world. That is a lot of additional crude where we're not finding anywhere in the world. Alex, I think you've, bounced around the world and covered things really well. Things in Europe, not so great. Things in China, not so great. And then that kind of leaves India lurking somewhere out there. Is what could India actually deliver? Classically fine negotiators, they will buy when it's low. So, is Indian demand going to change the world? Probably not. If we're in the upper 70s TI and low 80s Brent, $10 down from here, quite possibly. But, then there's the problem is the supply there. So I think that, right now, there's just such a mountain of evidence on the demand side that is just not that great. And that's why there's a prevailing, I guess, narrative of concern. Generally, the crude market wants to be bullish and the gas market wants to be bearish. And, lo and behold, the gas market, said, yep, see, told you, max bearish. And then Mother Nature says, oh, look, here we go. And then I think the rub on the crude side is the market generally wants to be bullish. And then once it finally decides that it's got to give up that idea for a minute, it almost feels like Murphy's Law. We will get the attack on Russian infrastructure because of our new long-range missiles, and or there will be something out of China that says, oh, no, it changed. Yeah, the Chinese side, I think it's easy to say, well, the jury's not out. This is a lot of months in a row of bad economic data. And then I got tariffs coming right behind that. That does not look great for China.
And it seemed like when they came out with the latest round of stimulus measures, people are really hoping to see an immediate effect from that, which I think also when that immediate effect does not appear in the data, then that adds kind of to the bearish sentiment for China's near-term outlook. But I think really the takeaway for that stimulus is that if they're targeting the property sector, and specifically within the property sector, the kind of just massive amount of unsold new homes that are just kind of weighing on the industry's investment appetite, that's going to take a while to lead into the kind of underlying commodity demand that's going to come from developer activity. So, it could be bullish, but it's definitely not immediate change. So I think that'd be kind of the caveat, is that it's definitely not appearing in the data now, but it's something that could into 2025. But as you said, tariffs are a big issue there.
All right, that exhausts it for me this week. I don't know if you've got anything else you want to cover. A little bit briefer than usual.
Good. And as always, throw the data deck in the show notes for people to check out. And we'll see you again next Friday.
Well, one last thought. With Turkey Day next Thursday,
that is true.
I believe maybe we will skip 1 week of recording and see folks again on December 6th.
Yes, so 2 weeks. All right.
We'll look forward to it. May you all have a wonderful Thanksgiving.
Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts, or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.